Yes, Matthew, thank you for the answer. Going back to your experiences, and in 2014, you joined Breed Reply as their strategy and commercial partner. And for those who are not familiar with Reply, it's a global IT service company. And it has, in 2018, it had a revenue of 1,000 million euros. So Breed Reply is a part of Reply and is Reply's investment fund. Can you tell us a little bit about Breed Reply and what is their investment focus?
Sure. So having raised funding for my companies, I didn't have a lot of respect for financial investors, and I never wanted to be a VC. That was never part of my plan. But in 2014, yeah, the majority of investors were financial investors, and yes, there were incubators and accelerators and company builders, but there wasn't really a model of what's coined today as smart money, although I don't like that terminology because it sends the wrong connotation. But there was a need in the market, a gap in the market, and Breed Reply, which is, as you pointed out, it's a quasi-corporate VC. They had the intention of building an operational support model around their investment. So looking at investing at seed stage, and then helping the companies to actually build their proposition, unlike an incubator and accelerator. So I joined them, with the intention of really disrupting and changing VC, the VC market, because I saw an opportunity, and Breed Reply was a startup. It was new. There was to start with, no professional investors involved there. So it was a very new concept that we were creating. So I joined them because it was new. It was exciting. It encapsulated all of my experience, especially as their focus was specifically around IoT. My background in that sector, the operational war wounds that I had in running my own companies, and being able to apply all of the experience that you've gained, into something that really was new and exciting.
And as a corporate VC, what kind of support did your team offer to the startups? Because it's like a 12-month program, right?
Yeah, and we evolved it. So I joined. So one of the other partners and myself built the operational model. It was an active operational model. So we would invest generally around £1 million into early stage companies. We created a structured program, but as you know, every startup is different. So that structured program, it was structured, but it was then bespoke applied to each of the companies depending on what their stage was, the management team, products, services. So we varied it, and it wasn't like an incubator and accelerator where you got a little bit of consultancy. It was going in and brass knuckles, roll up your sleeves, looking at strategy around product. We would go in and have a kickoff session with the management team and agree with them, where are the gaps, having gone through the due diligence process as part of the investment. You could see where the gaps were, you could see where they needed help, where the problem area lies, where they lacked skills and talent. So we would go in and we would be very above board, and we'd have a kickoff strategy session that lasted for 4 hours, and then we would go out and get them drunk to forget about all of that, and just to build that relationship with them as well. Social, which is so important, as well as both agreeing on the right strategy on how to build that business over that year program. And that included products, MVP, customer market fit, validation, customer validation, marketing, pricing, go-to-market strategy, as well as investment and financial. So it covered all of the bases, everything that they required. And the goal was that we would, go out, get them to market within that 12 months and be in a position to raise a bigger round investment at a higher valuation after 12 months. And we approved the model. We were successful. We made 24 investments in 4.5 years. We have 2 failures. I would say 1.5 failures, because the half was because we didn't make a second tranche investment payment because we had a rogue CEO. And in that period of time, we had 2 exits. So, at early stage, that was really the top of the curve from a VC perspective in what we were doing with a very different model. So we were able to prove that very well.
Yeah, that is super impressive. And you yourself actually also angel investors. And you are not unfamiliar with the Swedish market, because you actually invested in one of the spin-off projects from Uppsala University called the Pure Flow Solar Power. And they have received funding from Almi Invest, Almi Green Tech Fund, and also Eiteno Energy. Can you tell us a little bit about this specific company and how their solutions are different than the competitors?
Sure. You're right. They are an Uppsala University spin out from a professor who is an expert on plasmonics, and they've created a patented solar power plasmonic nanoparticle technology that can be embedded into glass and plastics that harvest energy from both indoor and outdoor light. So very new, type of technology. Where currently we have solar panels, but you don't go around putting solar panels on everything for energy harvesting, because you've got this black panel that is not transparent. And what they've done is they've proven that technology can be embedded into glass and plastics, where it's clean and sustainable energy, energy creation, energy harvesting. The surfaces are highly transparent, so they can be very aesthetically applied to different types of applications. They can be applied to both, flexible and rigid substrates, so very flexibly applied, lightweight, highly transparent, across different color spectrums. So regardless of the color spectrums, to absorb light, it's low cost, and can eliminate batteries required for low power applications. So really interesting new type of technology with applications such as electrochromic windows, low power sensing, for IoT applications, where you can use supercapacitors, they're competing in a market where you really have solar power, which is more efficient and can generate more power. However, it is limited to the applications. And then you have these different films that can be applied to plastics and glass, but they are also still films and very dark in color in order to generate sufficient energy. So this is really sitting in between those, in enabling a highly aesthetic, low or no battery capability for energy harvesting.
And what made you decide to become involved with the companies and as advisor and as investors?
So it varies. When I look at a company, and I get approached quite often to come in and look and both invest and advise, and I'm involved in a number of companies, really interesting companies. I look at, is technology interesting? Number one, because if it's not interesting, I'm not really interested. Is the product or service or the eventual product and service disruptive on a global scale. I'll look at market timing. You know, are they educating the market? Is the market ready for this solution? You know, will they buy this solution? You know, from a cost and product perspective. How is the product or service consumed? And you know, a lot of times you'll get a fantastic technology, but it's almost unusable in the market, or you have to create a complete new methodology on how to use or consume this, and that is very expensive and time consuming. And you know, lastly, I think, you know, does the company need assistance, and can I add value? So I look at it from a, you know, both a push-pull, both opportunity and, you know, is there can I add value, sufficient value to this company that really makes an impact? So when I look at new potential opportunities, you know, personally, you know, those are things that I look at.
And you have helped so many global companies to help them create strategic positions and also help them with investor readiness. So what are some of the common mistakes that you see founders make when they are looking to raise capital from angel investors or venture capitals? Would you please elaborate that with some examples? Because I think all the founders here today, they are looking to raise capital.
So at an extreme example, yeah. The startup thinking that they're going to become a unicorn in 12 months. Yeah, forget it. It's not going to happen. Okay, how good the technology is, it's not going to happen. Yeah, and if you think you can go out and raise 30 million at the end of 12 months, forget it. Yeah, this is a process, you know. And when you're looking at the VC space and raising money from venture capitalists, the formula has to work. And there are different VCs that invest in different sectors at different stages. So you need to know, you know, who, you know, which investors those are. And to give you an example, I received an email actually about a month ago. It was in January from a company who obviously didn't know how to use BCC. And they had about 200 venture capitalists, all CC'd in an email, most of them info at. Yeah. Number one, yeah, I would say that 99% of those went unopened. And number two, those that did open it probably sent them a scathing email back. So that is how not to interest a VC. And a very big mistake. Know your VC. Yeah, they need to know your market, understand it, like it. They are your best, you know, bet in trying to find funding. You might get lucky, but you'll waste a lot of time, you know, going out with a shotgun approach. Know your market. Some of the other mistakes are they think they know what their customers want. Instead of going out and actually engaging with their customers, they think they are experts, and they may be experts, but even if they are, it doesn't mean you don't engage with your customer. You get customers on board, show them your ugly baby as soon as you can, because that will only make your product, service, proposition better, earlier, faster, and allow you to get to market more rapidly. You know, and that includes both pricing and also product and pricing and commercial propositions. Yeah, your customers or your potential customers are the best ones to tell you that, and a lot of them love to get involved with that. They feel challenged, and they enjoy having their expertise utilized to give you feedback. And you don't have to know your pricing structure. You can take options to a customer. You can take options to them and say, look, we're looking at these types of charging models. Would that work for you? Explain it, take them through it. They will provide you feedback. They enjoy that. And if they don't, you have to question as to whether they're really a customer for you. So, you know, sometimes they're busy, sometimes they don't want to get involved, and that's fine. The majority of customers, from my experience, they love getting involved in this side of things, because it's new, it's dynamic, it's encouraging. and they like to be part of that story because it also benefits themselves. The only caveat I would add to that, never rely completely on what your customer tells you. or one customer, yeah, because that is a very dangerous strategy as well. Also, one of the big mistakes is, especially from technologists, that technologists think that the technology will sell itself. You know, if I'm going to develop some really cool stuff, everyone will just come and buy it. It doesn't work that way. you need to develop a product and proposition off the back of the technology. The technology just doesn't sell itself. And then I think probably lastly, and again, this is predominantly from a technology founder perspective. They tend to be features and functions focused rather than value and benefit driven. Customers don't care about features and functions. They want to know the value that it's going to return to them. So the sooner that you can get to a value and benefit driven ROI model based on your product and services inside a customer, the more likely it is that customers will understand your proposition better.